And joining me now with more is Adam Turnquist, Chief Technical Strategist at LPL Financial. Adam, great to see you this morning, joining us from Green Bay, Wisconsin. I got to ask you, as someone who watches the charts, how is the market set up right now?
Hey, good morning and Happy New Year. Thanks for having me. And right now, when you look at the market, it's a pretty constructive backdrop going into 2026. We're hovering just near record high territory. We're really watching for a close here above kind of 6,900. That would complete this multi-month consolidation range that the S&P 500 has been stuck in really since October. But when you look at what's happened over the last month, we've shifted more toward cyclical leadership. And I think that's a really important trend change that we've witnessed going from November, where we had defensive areas like healthcare and utilities starting to outperform. Now we have areas like financials starting to outperform and really lead the market higher here without all the support from big tech. And I think that's an important factor. The fact that this big tech trade has slowed down a little bit, we don't think it's over, but the cyclical leadership taking us into 2026, I think is a very constructive setup as we look ahead into the new year.
Let's talk about some seasonal statistics here. Of course, the Santa Claus rally currently underway, the stretch that is, but we don't necessarily see the S&P 500 booking gains that we typically do during this period. What does that mean?
Well, historically, this 7-day stretch characterized by the last 5 trading days of the year plus the first 2 trading days of the new year is a good one for the markets. Over the last 75 years, up 1.4% on average with a very high positivity rate. There's a few days left, though. We have until January 5th for the S&P to close above 6910. That's really the bogey to clear for a positive Santa Claus rally signal. And when you look at what that means for January, you tend to get above average returns, about on average 1.4%. And then even next year returns, when you have a positive Santa Claus rally, the S&P has been higher, just over 10%. Now, when you get a negative signal, which that's the territory that we're in right now, January tends to be flat to down with only average returns of the next year about 6%. So an important signal, but important to remember, we had a negative Santa Claus rally in 2023 and 2024, and we certainly had impressive gains during the last 2 years. So it's not always, seasonals don't always play out as expected, and we always think of seasonal data as really the climate, not the weather. And I think the weather for this market right now is again, pretty constructive when you look at the technicals, the fundamentals, and even really the macro backdrop into 2026.
I want to ask you about the precious metal space. We're talking gold, we're talking silver, a banner year for silver. That commodity up triple digits, and gold, I do believe, up double digits. But we've seen some volatility in this space just in the past week or so. What do our viewers need to know there?
Right now, it looks like profit-taking pressure after an impressive, really an extraordinary run in silver, up over 150% on the year, one of the best performing assets out there, and extremely overbought coming into year end. So we think it's really just some selling pressure as investors lock in some profits. We think the fundamental drivers are still there for silver. When you look at the demand side, it is an AI play. There's a lot of silver that goes into chips and in the data structure build-outs and really the green energy transition that's accelerated in these electrification trends. So we don't think those trends are changing. We're not necessarily telling investors right now to step up and buy the dip. We're watching for support and for momentum to change. We think there is some downside risk when you have these parabolic rallies end. They do tend to be in dramatic fashion, and the rule of thumb that we use as technicians is usually about a 50% retracement of that initial move. So that would bring silver prices maybe to $62 to $64. That would be some support levels to watch. But expect volatility. That's a theme that we highlighted in our outlook, especially as it relates to the metals space. It's a lot of policy that's driving some of the price action in the metals. And silver was added to the U.S. critical minerals list in November. There is a potential threat that tariffs get deployed in 2026. Same thing in copper as well. So that creates angst over global supply. You're seeing London silver start to move to the U.S. in anticipation of potential tariffs. So that's playing into it. Also, when you look at some of the more structural changes over the last couple of weeks that have played out, you have the CME Group implementing, I think today is their second time they've actually raised margin requirements. There was a very popular Chinese pure play silver fund that started to restrict investments. So that's weighing on sentiment a little bit as well.
So volatility could persist in the precious metal space. What's your expectation then for 2026? I know, Adam, you said earlier that you're constructive on your view for 2026. Does that mean more or less volatility overall for equities?
So for equity markets, we think more volatility as we expect it to be a more policy-driven market. We do think equities will move higher, but not in the same linear fashion as they did since April. We're looking at a year-end price objective for the S&P, kind of in the 7,300 to 7,400 range. We think earnings will be there. We've had 10 consecutive quarters of double-digit earnings growth. Margins, amazingly, still at record highs despite an effective tariff rate that's gone up almost 10% this year. So corporate America managing through these tariffs quite well. The consumer remains resilient. We think that will be a factor, especially in the first half, as the One Big Beautiful Bill Act delivers, we'll call it some above average type tax returns for investors. We think that could support consumer buying power as we look at 2026. So volatility, though, is very low. I'd say even complacent when you look at whether that's the CBO volatility index coming into the year near year-to-date lows, the MOVE index, which is basically the VIX for the Treasury market, at multi-year lows. And when you look at the macro backdrop, we're starting to see shifts in the path of monetary policy, whether that's the U.S. or the ECB or European Central Bank. Of course, the Bank of Japan and what's happening in global rates drifting higher. So we think those factors will probably allude to some more volatility in 2026.
All right, Adam Turnquist, Chief Technical Strategist at LPL Financial, joining on this final trading day of 2025. Adam, thank you and Happy New Year.
Happy New Year. Thanks.
All right.